Hi, I'm Jimmy. In this video, I'm going to walk through how ETFs are created. Now, I actually used to work at a firm that launched a high-yielding dividend ETF, and a few years later, after I left the company and started my own thing, they actually brought me back in as an independent contractor to rewrite the underlying rules of the index. So the goal of this video is to show how an actual ETF is created, what process it goes through behind the scenes, and ideally, to see if we can use that information to make better investment decisions and help us better understand how to analyze ETFs in general. Okay, so let's jump right in. So let's imagine that we have an idea for an investment strategy that we think would make a great ETF. ETF is short for Exchange Traded Fund. Well, one of the first things that we're going to want to do is to try to create a rules-based portfolio, which is the way most ETFs work. This rules-based portfolio you might hear called an index. An index is technically how they measure the performance of a portfolio or of a group of stocks or bonds or whatever it might be. So we create this rules-based portfolio, we turn it into an index, and then an ETF can go ahead and track that index and make it available for investors on the stock market. And all a rules-based portfolio is it might be something like this. Okay, give me a handful of stocks from a particular sector. And in that sector, we want the stocks that have at least a dividend yield of X amount, whatever that number is. And of those stocks, we want the top X number of stocks that have the lowest volatility. That's why they call this type of investment portfolio a passive portfolio. There's not an analyst or a portfolio manager in there picking individual stocks. They create the rules, and then the portfolio just follows those rules. This is the way most ETFs work. So the key to really analyzing any ETF is to try to understand the rules of the index as best as we can. Okay, so let's jump into the rules that we use to create the TFMEPS HIPS index. That was the index that we just recently rewrote the rules for last year. By the way, if you're curious, TFMS was the company that I worked for, and HIPS is short for High Income Pass-Through Security. We called it a pass-through because most companies in the portfolio are companies that don't have to pay corporate income tax as long as they pass through all of their profits in the form of dividends. Now, this is an advantage for us investors because where the typical company might earn a profit, then they pay taxes on that profit, and then after they pay those taxes, they're able to pay dividends. The advantage of these companies is that they don't pay taxes, therefore they have more money to pay dividends, and to get that tax exemption, they're required to pay out most of that profit as dividends, so you end up with much higher dividend yields. Now, if you're wondering how I got the call to rewrite the rules for this particular index and ultimately the ETF that tracks it, well, that's because my father owns that investment company that manages the index. So when it needed some updating, he called me, which frankly works for me because apparently I work cheap and this is what I do. And I got a very cool experience out of it on my resume, so I was happy to do it. Okay, so now let's jump over and look at the rules. So we had 4 sectors that we wanted to focus on. First is MLPs, which is short for Master Limited Partnerships. They tend to be energy-related stocks. Well, let's pretend that this circle right here represents the basket of MLPs that we're going to add to this portfolio. Okay, next up, we wanted REITs. REITs is short for Real Estate Investment Trust. And as you might have guessed, these are companies that invest in real estate or perhaps mortgages. REITs are another great group that tend to pay very high dividends because they're tax advantaged. Okay, then we have BDCs. BDCs is short for business development companies. BDCs can be best described as a venture capital firm. They tend to be venture capital-like firms, if not venture capital firms themselves. They usually go after medium-sized businesses, and what they do is they either buy equity positions in those companies or maybe they loan them money. Either way, they end up collecting in a decent amount of money, paying out pretty good dividends, once again, tax advantaged. The last group is closed-end funds, or CEF for short. Closed-end funds are sort of like mutual funds or ETFs, except once they get funded, they generally don't accept any more money after the initial funding, hence the name closed-end funds. Closed-end funds can invest in almost anything. They can invest in stocks, bonds. It could be corporate bonds, municipal bonds, government bonds, foreign stocks, foreign bonds. They could go pretty much anywhere. Okay, so these are the 4 sectors we're pulling from. And here's what we're after. We want to identify 15 companies from each of the 4 sectors, and we're going to combine them to create a high dividend portfolio. So for that to happen, I had to go ahead and create a few sector-specific rules. For example, MLPs, they needed to have a high dividend yield, they needed to have a market cap of greater than $1 billion, and I wanted the volatilities of the companies that were selected for the final portfolio to be low relative to other MLPs over the past few quarters. Okay, then something like closed-end funds, well, they should be trading at a discount, which means that when we buy their portfolio, when we buy the closed-end fund, we want it to be worth more than what we're willing to pay for them. So ideally, we're sort of value hunting there. Then we had similar rules for REITs and BDCs. Okay, now this brings us to how we put them all together. So there's something called the minimum variance portfolio. And basically for us, this is a way for us to decide how the weights of the portfolio will ultimately be based on the volatility or the risk reward profile of each sector based on the recent movement, call it the past few months, of those companies. So if they were all the same, if they all had the same risk reward profile, they would each get a 25% weighting. Okay, that's simple enough. But what if BDCs we find are a bit more volatile and REITs happen to be a bit less volatile? Well, maybe REITs get 35% of the portfolio and BDCs get just 15%. Now, to come up with these exact numbers, I went ahead and followed the formula for the minimum variance portfolio, and the results assigned the very specific weights for each sector. And then we take that weight and divide it by the number of companies within that sector, and we equal weight them amongst the other companies. So if one sector gets 15%, well, there's 15 companies in there. Each company represents 1% of the total portfolio. And the only real limitation that we had beyond that was sort of a tricky one I had to work into the rules, and that was regarding MLPs, or Master Limited Partnerships. And that was we couldn't get more than 25% of the total portfolio in MLPs. If we did, then we got hit with this annoying tax, or these annoying tax forms that we had to fill out, not we, the company, but us investors had to fill out, called K1s. They're a huge headache, so we try to avoid them. If the portfolio stayed below 25%, investors in this case, in the ETF, wouldn't have to get the K1. So we worked that into the portfolio. MLPs stay below 25%. Now, the ETF that tracks this index is called the Granite Shares HIPS US High Income ETF, ticker symbol HIPS. Now, as you might have guessed, the company that owns the HIPS ETF is called Granite Shares, and they own a few different ETFs as well. And ultimately, it's up to Granite Shares how they want the ETF to pay their dividends and what fees they charge and all of that. And what they've elected to do with the dividends is to pay a dividend of a bit more than 10 cents per month. So they pay a monthly dividend, and given that the ETF is only trading around a bit more than $12 per share right now, ever since the coronavirus crash happened, the current yield of the overall portfolio is more than 11%. So we gotta like that. Now, I've thought about doing a more in-depth video on each of these 4 individual sectors or these 4 investment types and walk through what they are, their advantages and disadvantages, how to value them, and how they look right now from an opportunity standpoint. Please let me know in the comments below if you think I should do that type of video. And if you're interested, I'll leave a link to the HIPS ETF in the description below. Now, just so we're on the same page, I'm not being paid to talk about this ETF. This isn't a sponsored video. Yes, my father works with Granite Shares, so I suppose he gets paid if more assets end up in the fund, but I don't. So take that for what it's worth. The only thing I get out of this is that I get a contractor's fee from my father's company when I rebalance the index, and I get that no matter what is in the ETF. So for me, this is really just something that I was proud of, something I spent a lot of time working on, trying to figure out how to do this, how to do the back testing. The whole strategy itself was a very interesting thing to try to put together. Now, I've already done a primer video on a few of these asset classes already. So if you're curious, perhaps the real estate investment trust primer is a good place to start. That's where I would start. I'll leave a link in the description below to that video, and there's a link right here if you're curious. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thanks, and I'll see you in the next video.